pressure.
Okay, thank you very much for that. Vinod Karki, the head of strategy research at ICICI Securities, is also with us to talk about the market fundamentals. Vinod, thank you very much for joining in. I want to start off with your recent note that you published on 6th of December, where you are saying equities have now reached high optimism zone. And typically, when Indian equities trade at valuations, which we are currently trading at 20, 22 times forward multiple, we see poor returns in the future. Can you talk a little bit more about what you anticipate playing out? And will it be different this time? Because history doesn't always repeat.
Yeah, thanks, Rima. Yeah, that's absolutely right. History necessarily doesn't repeat all the time. But if you look at the past 20 years, 1 year forward returns, when we reach area of valuation exceeding 20x, we have seen low single-digit expected returns overall. But if you split it up, there is also a chance of negative returns, 34% probability that there could be negative returns. But if you look at the positive return, the average has been around 9%. And we have been very bullish on the overall investment credit cycle and the overall domestic demand. So from that perspective, I think we may land up in the positive zone in terms of 1 year returns. But nevertheless, this return will be subpar. So if you even take the historical average 9% return that the market has given from this kind of range, then it is below the expected return that investors ask when they invest in equities, taking the risk. They at least ask for 12, 13% kind of compounding. Now, if you land up with single-digit returns, it is not up to the mark, basically. And if you go beyond 20x, the earnings yield dip below 5%, whereas bonds are yielding more than 7% right now. So relatively, also the asset class, becomes less attractive overall. Yeah, but all said and done, it seems that we will land up in the positive territory in terms of returns, but subpar returns compared to expected returns.
All right, positive territory but subpar. Mr. Karki, good morning and thanks a lot for joining us. This is Pavitra. You've also mentioned in your note that earnings growth, will not be too bad and we will see expansion continue as far as earnings grow. Can you tell us what is the kind of earnings growth you're penciling in for next year, for FY24?
Yeah, so when we came up very strongly from the post-COVID low base, especially supported by financials and commodities, out of that, financials is continuing, both in terms of top-line demand and the margins. But commodities have given way. I mean, you have seen how commodity earnings have been impacted, also because of taxes also. But financials continue. And what is going to help in the next year, what we are observing right now, is that the price shock, the input price shock that we saw after the Ukraine war, I think that is abating. Globally, if you see, commodity prices have been falling. The cost of logistics is falling. So I think that will have a positive impact on margins for manufacturers. We are seeing that commentary also come from the PMI internal commentary, that manufacturers are seeing lower input cost pressures right up till November. And this will continue, it seems. Whereas the domestic demand seems to be quite robust. So this combination of robust domestic demand and input cost pressure easing for manufacturers may help earnings trajectory. And financials are doing pretty well and they form a large part of the weight. However, commodities and global related, where global demand is under question, those areas might see some muted demand overall.
I was also going through your note and looking at your top picks, whether it's in the consumption space or overall. There is one theme that stands out, which is the housing theme. So, whether it's Century Plyboard, something like a green panel, Brigade Enterprises, you like a lot of these real estate and the ancillary spaces. Do you think that there is still a lot of upside here? And within that gamut, would you stick to names like, say, Brigade, the Lodhas of the world, or would you get into, ceramics, tiles, the green panels?
Yeah, so first of all, real estate is coming out of a decade, almost a decade of stagnation. And historically, we have seen that, these trends do change post a decade or so. And over the last year or so, we have seen this absorption of real estate in urban areas really pick up across the board, across the country, basically. And it has also resulted in uptick in prices. So investors or users both get a little excited when they see an uptick in prices of any asset class. And real estate is no exception. So I think the demand for real estate will continue despite the slight increase. I mean, not slight, I mean, quite a bit of increase in interest rates. But what really drives any asset class demand is the uptick in the asset prices. So that's picking up. So we think we are in for a cycle where real estate demand is picking up. And typically these cycles don't fizzle out in a year or so. So our view is that this real estate cycle will continue, and it forms a large chunk of the gross fixed capital formation, which will help the investment rate also. And therefore, all these ancillary companies, and where you have a lot of faith in the company's governance and the quality of management and the ability to manage the balance sheet, which is of prime importance for real estate, I think one can bet, because these cycles don't fizzle out in a year or so, as I said. They can continue for several years.
You're also of the opinion that companies tied to global demand are likely to have a weak growth outlook. Now, usually stock prices run ahead of fundamentals, right? The stock price is correct and then the bad news follows. Can you talk about IT? Because we've already seen a substantial correction. The Nifty IT index is down 25-30% so far this year. Do you think in terms of price damage, at least, the worst is behind us?
Absolutely. You hit it on the nail. I mean, it's perfect. I mean, that's how markets behave. The whole global weakness in terms of demand is already getting discounted big time in be it global commodities or IT companies. So the worst of price action may have been behind us, but we have seen time and again that wherever the demand environment continues to be weak, even when the news flow continues, there are no triggers for the stock to really pick up. Unless, till the time you don't see growth picking up, or those catalysts of growth showing up in terms of higher order demand and all those things coming in, the stocks continue to remain in the value zone. As there's no catalyst for these companies to really outperform. So that's the worry. Although the price damage may have been done, but what about catalysts? You need catalysts, growth catalysts, to really create alpha in the market, which I think will not be coming very soon, unless the US Fed pivots towards the quantitative easing from the quantitative tightening cycle, which I think will take some time. But if that comes about any time in the future, and which stimulates global growth, that will be the time for these, because these companies would have then sharply corrected also, and there will be time correction also. That will be really good time to pick up these stocks.
Okay.
But yes, the major price corrections have been done.
All right. Most of the price correction is in for the IT pack. That is the word coming in. The other question I want to ask you is on the FMCG space. I know you have a lot from that basket, but we have been hearing so many concerns of how rural is not quite there yet. Demand is still lagging significantly to what's going on in urban India. Is that a concern? And in that context, do you think this space is still good for some upside in the near future?
So what is happening in consumption is a clear dichotomy. We are seeing mass scale. Wherever there is mass consumption, low-end consumption, that has been impacted. But wherever there is a bit of discretionary consumption angle, and there is some amount of value comfort. You have to remember that from last couple of years, the value as a strategy has been outperforming. Whereas very expensive stocks have been underperforming broadly. So in this consumption basket, wherever we have a valuation comfort and the discretionary consumption angle is there, I think those areas will continue to outperform. The very expensive, which are beyond one standard deviation valuation in terms of expensiveness, whereas the growth is muted. I don't think that there you would be able to see outperformance from these sectors.
Okay, all right. We will let you go on that note. Thanks a lot for joining us, Vinod, and speaking about the markets. Well, that's on the earnings, the way the markets are panned out, as well as individual stocks and sectors that he likes. As we slip into a break, there's just 24 hours to go for mutual fund visionaries like Navneet Munot, Shrikant Nadella, Nilesh Shah, Radhika Gupta, and more decode the future of the mutual fund industry. Join the conversation on Money Control Mutual Fund Summit in Mumbai on the 14th of December, 3:30 p.m. onwards.